Okay, well, thank you all for being here, and thank you, Vitaly, as well. So let me continue here. My role is to talk about the year as well as the quarter, and I write a quarterly commentary, and much of my presentation will be taken from that. The quarterly review topics are many. First half of the year, the shocks, the bond bull market, and other issues, and we'll try to get to all of that, hopefully in a relatively short period of time. So the year started with a loud thud. There was an enormous sharp plunge in the stock market in China. The China trading halt in the first week, after the first half, after 30 minutes of trading in one of the days of the first week. So the central bank was trying to shore up the market. Shanghai Composite at the middle of January was an amazing 25% down, and there were severe global downturns as a consequence in most all of the global indices. Just to remind you, the world as it existed at that time period, NYMEX crude was at the mid-20s in February. Of course, it's now 50. First half of the year was fear in global capital markets. And of course, as we know, when fear comes along, gold does very, very well. It rose sharply until the middle of this summer. There were many discussions about the impact of negative long-term rates in the Eurozone and Japan, and doubts about monetary effectiveness. There was the Fed itself was wondering what they should be doing about all of this, and it decided to be extremely conservative, put rate rises on hold, and be concerned that the U.S. economy is going to do well in spite of all of the things going on outside of the economy here. At the end of the half of 2016, however, there was an abating of the fear. However, there were more shocks to happen in 2016. One of the most important ones is the Brexit vote that managed to devalue the UK economy and every British citizen something in the order of 25%. And the pound is, as you know, still declining well beyond the 25% it was. London is issues as the World Financial Center, and the Eurozone itself. People were wondering about how its viability was likely. A lot of things to think about in the world, but there's another one. The presidential election was probably the most severe unforecastable shock, defying a wide consensus and forecasts, and an economic reset and a political reset globally that continues well beyond 2016. What's the most shocking surprise? Well, in spite of all of this stuff, capital markets seem to shrug it all off. The year-end indices were mostly all positive, or at least neutral. Japan wiped out a 20% decline and posted a small gain by the end of the year. U.S. equities, however, were doing well pretty much most of the year. There was kind of almost a slow, grinding rise in the value of equity indices starting in mid-February. And, of course, at the end of the year, there was this post-election surge that in terms of resolving election uncertainty that I'm pretty sure everybody in the world was concerned about. What about bonds? Well, it's in some sense just the opposite. Okay, there were large returns in the first half of the year and givebacks in the second half. There's some really amazing things going on in the bond market. The UK October real yield, 2068 gilt, had a negative interest rate of 1.95%. And it's almost beyond belief. A 68% gain up until that point in the market. Still worth more than 50%. The U.S. 10-year reached a low of, I think it was in July, of about 1.36%, and since then been rising, of course. And gold started to decline after hitting a high of 1350 by in the middle of the year. Okay. Well, dollar strength, okay? Dollar peg currencies are particularly affected, and after the Fed rate rise in 2015, the Chinese 10-year immediately went up to 3.4%. So China is particularly vulnerable to dollar strength, and they've been spending an awful lot of money to defend their renminbi. Currencies are a big issue this year, I'm pretty sure, as well as it has been last year. The Chinese managed to spend $1 trillion to defend the renminbi. That's an amazing number. They used to have $4 trillion, now they have $3 trillion. It's still a very wealthy country, of course, but now Japan is the largest U.S. creditor, not China anymore, which of course has interesting political implications. The downside of negative rates, there was about $5.6 trillion of negative rates at the beginning of the year, kept rising to about 13. It's roughly about 10 currently. German yields are negative at 2024, an amazing thing. The trouble is that negative rates, nobody really understands them. There's no monetary economic theory that helps you understand how to think about this. So it's kind of like a black hole in economics. And the trouble is that all of this is sitting out there, and there are lots of unforecastable risks in global capital markets. Nobody's going to be able to anticipate it. And there's a kind of vulnerability of global capital markets associated with these negative rates that nobody really understands, and we have to be very concerned about that. It's a looming risk for global debt markets for sure, and global markets for sure as well. So what about the Fed? Well, the Fed had a little bit of an easier time than the other central banks. They decided to limit QE. QE is a disequilibrium effect and does have capital misallocation implications for global capital markets, and it also has social dysfunction implications as well, which may or may not have been related to the presidential election. But the economy continues to grow, and if it does, then this normalization associated with the Fed's policies is likely to have limited market impact. I kind of think that might be true. As long as the economy continues to grow in some reasonable way, even the stock bond premium can remain relatively constant. We can have fixed low rates for extended periods. I think we might need to be considering that 2.5% is kind of a perfectly reasonable 10-year rate. I'm not sure that is true for all of 2017, but it seems to be a near-term local equilibrium range. And since then, after I wrote this, it's actually declined to 2.36, I think, right, Vitaly? Something like that. So it didn't go up anymore. It just actually started to go back down again, so after the sell-off. So there might be something to say about not worrying too much about all of that. This year's, for me, is less than. I think we all have heard this before, and we always hear about it after things have kind of cleared up a little bit. Don't mix trading with politics. Political upsets have often little impact on long-term market trends. There are a number of hedge funds that got the politics right and still lost money. No major flight to safety resulted. A lot of bearish bets that ended up with significant losses. What really matters? Well, the economy. And that's, it's the economy, stupid, right? What mattered most is the long-term trends and some of the dovish policies associated with the Federal Reserve in particular. The China question remains one of the key risks of global capital markets. They're trying to transition the economy. They're trying to root out corruption and reform the economy as well. We wish them well because their success matters a whole lot to global economic growth as the second largest economy in the world. The Fed December letter is, they told us that they remain accommodative, the guidance for gradual increases, not big increases, but gradual increases. Full employment in the United States, that's an amazing thing after 2008. Inflation is close to target, depends on which one you want to use, but it's still relatively considered to be so. And the key questions that they talked about is, well, what is going to happen in 2017 now that we know that Donald Trump will be president starting January 20th? So they considered the possibility of faster pace increases. An awful lot of economists are concerned that if the stimulus policies that have been talked about actually go ahead, there could be an overheating economy as a consequence, because now we have relatively full employment and inflation close to target. We don't need stimulus like we did before, fiscal stimulus that is, and we could overheat if it's not done properly and well. Of course, it could be done well. So the Trump political economy proposals are all things that are on people's minds, and there are a number of them that might have serious bipartisan support, like eliminating interest rate deductions. Certainly, the whole Russian issue is an extremely controversial one. I'm not going to go into that. Lowering corporate taxes might be a really good idea. Some infrastructure spending might be a very good idea. But there are many controversial issues here that need to be thought about as good investors should. Immigration policy done wrong, could limit supply of labor. And that is not a good thing, especially highly qualified people coming into the United States. A trade war could, with China and Mexico, we don't want to go there, okay? A fiscal stimulus that is not oriented to growth could lead to recession at some near-term point. We certainly do not want to have ad hoc interventions in the Middle East. That can backfire all kinds of ways. And job owning, destination taxes are all issues that seem very popular, but you know, they can reduce competitiveness, especially with firms on a global basis. We care not only about what's going on in the United States, but what is going on globally, and we need to be globally competitive. And hacking does need to be paid attention to. It cannot be ignored. Domestic security is far too important, okay? There are many additional unknowns in a global economy. There are major political divisions in the Congress itself, even among Republicans as well, of course, as among Democrats. There's been 8 years of a QE economy, and it's still weak. It is not strong. It's still weak. It's very tentative. There are productivity issues. There are labor force issues. There are economic inequality issues. There are kinds of economic growth, sustainability issues. And so, as a good investor, we are wary. Wariness is the order of the day. The VIX index remains at something less than 12. But one has to wonder whether the global economy is on standby and wondering what comes next. So let me go to something a little bit more of a longer-term issues at this point. The ETFs. One could, I think, very successfully argue that ETFs are the most successful financial innovation in the last 25 years. But there are a number of critiques of ETFs that have occurred in the press, and some of them by people who we all revere, like Jack Bogle. And Jack has written written an article or two that is a critique of ETFs. And what he said, and we agree with what he says, of course, that they can encourage excessive trading relative to mutual funds. They have. They can have a complex or liquid structures relative to index funds. That's also true. And there are an awful lot of ETFs, and confusing for many investors. But my point is that those are not limitations of ETFs. Those are limitations of how they can be managed and how they are sold. Excessive trading is not an inherent fault of ETFs. It's how they're managed. Many ETFs are not illiquid. They're not risky, and they're not costly. Many of them are very low cost, very low risk. In fact, they are the most low-risk assets you can find. And the spectrums of ETFs is just an artifact of extreme interest in getting ETFs into market by the big financial firms. We do not do any of these things. We are a real pioneer in ETF management with just about one of the longest track records of any asset manager in the world today. We are well aware of limitations of ETFs. We invest in U.S. liquid, low-cost index fund ETFs. U.S. liquid, low-cost index fund ETFs. U.S. ETFs trade more tax efficiently than mutual funds. Not non-U.S. ETFs, but U.S. ETFs do. Index fund ETFs, very low cost. They are highly transparent. They're not illiquid. They are not complex. And we control excessive trading with the Michaud rule that Paul was talking about earlier. So the ETF critiques do not apply to New Frontier, do not apply to any of the portfolios that you are investing with us. Another issue that is a very topical one is smart beta ETFs. There's a whole lot of interest out there in smart beta, or what are more generically called factor ETFs, and I think that is a better term for it. Bill Sharp, I know, hates smart beta. Okay, so these are viewed as low-cost hedge and active quant funds. Hedge and active quant funds are often very expensive factor funds. That's what they are in many cases. And the trend has been that active is losing ground to index ETFs, and smart beta ETFs are hedge and quant management at much, much lower fees. So what's not to like? Okay, it sounds like a great deal. And why doesn't everybody do that? Instead of giving the excessive fees to quant and hedge fund managers, just buy smart beta or factor ETFs. Well, it's still an early period of time, and here's some caveats I hope it's useful for your thinking about it. Smart beta can vary widely in quality and reliability, very widely. Outperformance is often just back-test performance rather than actual. You need to worry about that. Some of the factor ETFs go back to 1966 for their performance. It's quite a long time before they actually occurred in the world, in capital markets. Which factor or factors to use are still wide open issues. Unlike index funds, they don't trade the same way. Index funds trade price neutral. Factor funds do not trade price neutral, so they require smarter trading strategies that can go wrong. Okay. So, as a friend to our friends here on the conference, the usual caveat emptor applies. There's probably a shakeout showing up shortly. Yeah. So one other thing to talk about is active versus passive. 2016 has been another year of not very happy active investors. Active investors have been whipsawed with large negative active and hedge fund returns. Many of the hedges backfired very badly. New Frontier actively is an active manager. We invest in passive funds, but we are an active manager of passive funds. We pay lots of attention to markets. We pay a lot of attention to economic issues and global risks and all that. Our strategies are tested nightly for what we call statistical optimality with the Michaud-Ash rebalancing rule. So our technology is different from anybody else's in the world today. That all leads to an inherent far less need to trade. In our process, it tends to be largely immune to hype. We test for statistical optimality, and we carefully decide whether the portfolios are really very different or not, and if they're not, we just stick with them. And these are consistent with good principles of long-term investing.